Hold on to your hats, folks, because we're diving headfirst into the wild world of tariffs and their impact on the stock market. Tariffs, those taxes imposed on imported goods, can create ripples that affect not just the companies involved in international trade, but also the broader economy and your personal investments. Did you know that a single tweet about tariffs can send shockwaves through Wall Street, leaving investors scrambling? It's astonishing how quickly market sentiment can shift based on a few words from influential figures. It's true. Tariffs, those pesky taxes on imported goods, have become a major player in the global trade game, and understanding their impact on your portfolio is more crucial than ever. When tariffs are announced, they can lead to immediate changes in stock prices, affecting everything from consumer goods to industrial supplies. We're talking winners and losers, folks. Some industries might benefit from tariffs, while others could suffer significant losses. It's a complex web of cause and effect that can be difficult to navigate. Some companies, like domestic manufacturers, might see their profits soar when tariffs are imposed. These companies can gain a competitive edge as imported goods become more expensive, making locally produced items more attractive to consumers. But others, like tech giants who rely on global supply chains, could face some serious headwinds. Increased costs for components and materials can squeeze profit margins and lead to higher prices for consumers. It's a high-stakes game of trade-offs, and we're here to break it down for you so you can make smart, informed investment decisions. By understanding the nuances of tariffs and their far-reaching effects, you can better position your portfolio to weather the ups and downs of the market. Stay tuned as we delve deeper into this intricate topic, providing you with the insights you need to navigate the tariff tightrope. Now, before we get ahead of ourselves, let's take a step back and define what we mean by tariffs. Simply put, a tariff is a tax imposed by one country on goods or services imported from another country. Think of it like a border toll for products crossing international lines. Governments impose tariffs for various reasons, but the most common one is to protect domestic industries from foreign competition. By making imported goods more expensive, tariffs can make locally produced goods more appealing to consumers. Of course, this can also lead to higher prices for consumers, but that's a whole other can of worms we won't open today. Now, here's where things get interesting for investors. Tariffs, by their very nature, introduce a level of uncertainty into the global trade system. And as any seasoned investor will tell you, uncertainty can make the stock market as jittery as a caffeine-fueled squirrel. Why is uncertainty such a big deal? Well, businesses thrive on predictability. When tariffs are introduced or even just hinted at, companies face a whole new set of unknowns. Will the cost of their raw materials skyrocket? Will they have to find new suppliers? Will consumers balk at higher prices? These uncertainties can wreak havoc on a company's bottom line and, as a result, their stock price. Section 4. Winners in the tariff game, domestic champions rise. But it's not all doom and gloom in the world of tariffs. While tariffs can create challenges for many businesses, they also open doors for others. While some companies tremble at the mere mention of trade wars, others see it as an opportunity to shine. These companies are often nimble, innovative, and ready to capitalize on the shifting economic landscape. Domestic manufacturers, in particular, often find themselves on the winning side of the tariff equation. They can leverage their local production capabilities to meet demand that would otherwise be filled by foreign imports. Take Nucor, one of the largest steel producers in the United States. Nucor has a long history of adapting to market changes and turning challenges into opportunities. When tariffs are slapped on imported steel, Nucor suddenly finds itself with a significant price advantage over its foreign competitors. This advantage allows them to capture a larger share of the market. This can lead to increased sales, higher profits, and a surge in their stock price. Investors often take notice, driving up the value of the company's shares. The same goes for other domestic manufacturers like U.S. Steel, who suddenly find themselves with a more level playing field against foreign rivals. These companies can reinvest their profits into further improving their operations, hiring more workers, and boosting the local economy. It's a ripple effect that can benefit entire communities. When domestic manufacturers thrive, they create jobs, support local suppliers, and contribute to the overall economic health of the region. Of course, it's not a guaranteed win for every company. Success depends on a variety of factors, including the ability to innovate, manage costs, and respond to market demands. But for those who can navigate the complexities of tariffs, the rewards can be substantial. In the end, tariffs can be a double-edged sword. They can create challenges, but they can also create opportunities. For domestic champions, the rise can be swift and impactful, reshaping industries and driving economic growth. Section 5. Losers in the trade war. Tech giants and automakers feel the pinch. On the flip side, some companies feel the sting of tariffs more acutely than others. Tech giants like Apple, for instance, often rely on complex global supply chains to manufacture their products. When tariffs disrupt these supply chains, it can drive up costs and eat into profit margins. Automakers like Tesla are also vulnerable to tariff wars, as many of their components are sourced from overseas. Section 6. Weathering the storm strategies for investors in a tariff-heavy world. In today's interconnected global economy, tariffs can create significant turbulence for investors. Understanding how to navigate these stormy seas is crucial for maintaining and growing your investments. So how can investors navigate the choppy waters of tariff-driven market volatility? The key lies in being prepared and staying informed. Just like a skilled sailor, you need to have a strategy in place to handle the rough patches. Knowledge is power, my friends. Staying updated with the latest financial news and understanding the implications of new tariffs can give you a significant edge. Regularly read financial reports, follow market analysts, and participate in discussions to stay ahead of the curve. Keep a close eye on global trade developments and pay attention to how different companies might be affected by tariffs. Diversification is also key. By spreading your investments across various sectors and regions, you can mitigate the risks associated with any single market or industry. Don't put all your eggs in one basket, especially if that basket is heavily exposed to tariff risks. Diversifying your portfolio can help cushion the impact of sudden market changes and provide more stability in uncertain times. Consider investing in a mix of domestic and international companies across different sectors. This approach not only spreads risk, but also opens up opportunities for growth in different markets. Finally, don't panic. Knee-jerk reactions to tariff announcements can lead to costly investment mistakes. It's important to stay calm and not let emotions drive your investment decisions. Reacting impulsively can often do more harm than good. Take a deep breath, assess the situation, and make informed decisions based on your long-term investment goals. Remember, investing is a marathon, not a sprint. By staying informed, diversifying your portfolio, and keeping a level head, you can successfully navigate the complexities of a tariff-heavy world. Section 7. Conclusion. Navigating the tariff maze for investment success. The world of tariffs and their impact on the stock market can seem like a complex and daunting maze. But by understanding the basics, staying informed, and keeping a cool head, investors can navigate this challenging landscape and come out ahead. Remember, folks, knowledge is power, and in the world of investing, that power is more valuable than ever.